Are you a small business owner thinking about selling your business? Or you own a business you're not currently thinking about selling, but you just want to know what would go into that if you were? Well, I'm Sean from Ledger Ready, and today I'm going to talk you through what that process looks like and what you will need to have in place before you even think about selling. Now, before I jump in, if you like this video, by the time you get to the end of it, please hit like, subscribe, and check out my email newsletter at ledgerready.work. I send out accounting tips occasionally and just general business financial tips to help you succeed. Now, I'm Sean. I've been a CPA for 13 years, and I've worked with many different businesses in that time. I was in public accounting for about 10 or 11 years, and in that time, I've seen dozens of different companies in many different industries, some of which just emerged from bankruptcy. I've also been on the bank side, auditing large banks, some of which were public, others simple community banks. I've seen companies with international operations that had just sold to a private equity firm or were heading towards a sale to a private equity firm. And so I'm going to give you some perspective from a CPA about what you'll need for financial statements to get through this process, but also what those private equity firms and those brokers will be looking for from you in order just to be considered for sale. So we're going to jump right into that. Okay, how to prepare your business for sale. Let's jump in. Okay, here's the process at a high level. You have sourcing and initial contact. Maybe you are working with a broker. You found someone in your local market and you're like, can you find me a seller? Rather a buyer. I'm looking to sell. Been running this business a long time and I'm ready to retire. Or maybe you're one of the lucky ones and someone found your business and they said, hey, I really like your brand. I'm thinking about buying and getting into this market. Let's chat. So let's say you find someone, you're not sure where you want to go from there, but you're ready to move to the next step. You have the initial financial review at that point, followed by letter of intent, followed by due diligence, which is followed by final negotiation and closing. So let's dig into what each of those were. So I talked about sourcing initial contact. You have an interested party who wants to buy or is thinking about buying, and you've hired a broker or they've hired a broker, and you're thinking about potentially moving to the next step. And so the buyer is going to look for some information right off the bat. You're going to sign some kind of confidentiality agreement so that they can get information from you, and they're going to start looking at your numbers very high level. Do you have strong recurring revenue? What's your customer base look like? What kind of growth prospects do you have? Do you have steady growth on the top line, that revenue line? Are your operations scalable? So is your company suited to growth with more investment? Could I just hire more employees and get some growth that way? Are you, the owner, ready to exit? They don't want someone obviously who's going to back out last minute. They don't want to pay all this money for due diligence and then not have the deal work out simply because you weren't really ready to sell. And then you might have the last bullet here, the back end systems that are fixable. So you might have some processes in place. Maybe you put a Band-Aid over certain things, and it's not perfect. That's what small business life is like. You do the best you can. You focus on the things that are most important, and sometimes things get pushed aside. So you don't have to be perfect. You don't have to have the perfect process and procedures in place to be sold. But it can't be a complete mess. The buyer wants to be able to come into a situation where they're set up to succeed. So a back-end system that's a little messy but is fixable is no problem. In fact, that's what they want, because then they can get a discount on the purchase price, and hopefully get an easy win right away, right off the bat. So that's kind of the first phase. The next phase is when they're going to start digging into the numbers. They're going to look at a few years of your income statement, your P&L. They're going to look at your current balance sheet. They might look for multiple periods for comparability. They might ask for revenue by service or product line to see, okay, which products and which services are growing. Because they might have initially looked at your business and been like, oh, they're in this market. But when they get the revenue by service or product line, they might find, oh, well, the product or the service line that I was initially interested in is on the decline or has been stagnant for the last few years. So maybe this isn't really what I was looking for. They may also ask for certain customer information. And the key here is concentration risk. They are looking for red flags. They want to know, okay, do you have a single customer that accounts for 90% of your revenue? Are all your customers concentrated in a single geographic area? And why that would matter is so what if you have one customer that accounts for the majority of your revenue? If they failed, you now lose all that revenue. It could go out of business simply because of that one customer failing. Similarly, if they're all in the same geographic area and there was some sort of event, like a weather event, or an economic event that affected that specific area, it could have the same impact on your business. It could kill your business because of one single event. And they're also going to look at trends in KPIs. So these are key performance indicators, usually specific to an industry. They're going to be similar across similar businesses, but you may have certain indicators that you like to look at. So they're going to want to know that, okay, how are you gauging your financial performance period over period, and what do those trends look like? And so some of these trends are super basic. It could be simple as gross margin trends. Like what are your costs of goods or cost to sell going down? How's your margin looking? Is it getting tighter? Is it harder to take that money to the bottom line? So how price sensitive are your customers is another way to look at it. If your costs go up, how much can you pass on to your customers without killing your sales? So those are the types of things they're going to look at there. So that's gross margin. There are others, of course. So if you're a balance sheet heavy business, meaning you need to invest in a lot of property and equipment in order to deliver your product or service, then a buyer is going to look at how healthy that all of those assets are. Are they new? Am I going to have to buy new equipment in the next few years? Things like that. So lots of different ways to look at this. And that's very specific to your business, but this is early on. This is what they're thinking about. So next step, they say, okay, I have the last bullet here really nails it on the head. It's like passing a note to someone you like in middle school. I like you. Do you like me? It's like check this box if yes, or this box if no. So this is like, hey, we're thinking about buying you. We like your business and we hope, we're a good buyer for you and going to be a good match. Here's a range. There's the purchase price range. They're probably not going to have a single number at this point, but they might give you a range that just says, here's what we're thinking, a multiple of your EBITDA or whatever it is. And here's what we're thinking about. It's an all cash offer or an earn out or equity rollover, which essentially means, so cash, obvious, they're going to pay you some cash. They're going to get the business. Or an earn out model would mean that you would get paid out from the cash flows of the business over a number of years, which is buyer friendly, because if your company doesn't perform after they buy it, they don't have to pay you. And the last one, equity rollover, is essentially you the seller you likely get a combination of these, but an equity rollover is you get stock in the new company. So you buy, they buy you, they probably give you some cash, and for a portion of your ownership stake, and then you keep some stake in the new company, something like that. So then you're gonna talk about timeline and contingencies. If this happens, then this is how we're gonna handle it, and things like that. So that's the letter of intent. And now we get to the meat of the process. And this is where we're going to spend most of our time today. And this is due diligence. And saddle up, because this is where the work is in this process. And as you can see with this first bullet here, this really will feel in a lot of cases like a never-ending process. Like you're continuously getting requests, both from the buyer's team and from an auditor, which we'll get into if they require you to get an audit, which they most likely would for your financial statements. So this is a very involved process. You're gonna have to provide a lot of things, a lot of this information, it feels like a lot, but it's reasonable requests. They want to know, the buyer wants to know, am I going to be successful? What's the financial health of your company, and how can I rely on this financial information? So that's why they ask for audited financials, because what that means is a CPA firm is coming in to your company, you're paying them. This is a cost. This is a seller cost. You're going to pay a CPA firm to audit your financials, which means they're going to test your numbers and make sure that they are complete and accurate. They're going to make sure all your liabilities are accounted for. They're going to make sure your assets are all there, that they actually exist. And they're going to make sure that your sales are real and not fake, and all this information, that they got recorded in the right period. That you didn't just hold back some revenue, so to speak, and put it in the most recent year to make it look like growth. So like, they're gonna look at a lot of stuff like that. Cutoff is what it's called. Like making sure that everything gets recorded in the right period and things like that. So they're gonna ask your auditors and probably the buyer's team. So it's two separate processes. You have the auditors asking for historical information, and then you're going to have this whole other M&A team, a merger and acquisitions team. It may be a consultant that the buyer has sold. You will have one too. You will have your own team most likely, because you want to make sure that you're getting all the money that you possibly can. And so, you're shooting for a higher price. The buyer is shooting for a lower price. Hopefully, everyone just wants it to be reasonable so that everyone's happy. But these are the requests that you're going to be asked. This is the basic stuff. You're going to ask audited financials, like I said. Monthly financial information for a few years probably, because they want to see trends. Bank reconciliations. How much cash do you have, and can it be supported by a bank statement? Or do you have a lot of outstanding checks that haven't been cashed, stuff like that. Inventory reports, what's your inventory trends? They're going to want to know, and the auditors will verify this, but does your inventory exist? AR and AP aging, this is your accounts receivable and accounts payable. Are you paying your bills on time? Are your customers paying you on time? More importantly, payroll reports. How many employees do you have? What are they getting paid? What's that look like? Because this buyer wants to know, what's your overhead? What's who are your high paid employees? And what are their skills? Tax returns. They're going to want to know. They're going to want to verify what your tax liability is and things like that. And they're also going to want to know what your accounting policies and procedures are. They want to know that you have a plan, that you have structure, that you have a way of producing reliable financial information every month or quarter or however often you look at it. All right. And then the last step, financial negotiation and closing. Whew, you made it. You got through the audit, you got through the due diligence. Now you might have to renegotiate a bit, depending on what was found during the due diligence process. You got to narrow down your pricing and figure out what the final terms are going to be, and then you hopefully sign the agreement and you get paid. Cool. All right. Now let's talk about how we prepare. How do you get this done? So the financial statements, as you might have guessed, are critical. They're necessary. Nothing can be done without financial statements. You have to have them. And you can't just pass it off to a bookkeeper to handle for you. Now, a bookkeeper can do the day-to-day. They can record the transactions, and I get it. Most small business owners are like, I don't want to have anything to do with this. I'm not good with numbers. Or maybe you are and you just don't want to deal with the day-to-day bookkeeping. Who does? But you do have to understand your financials. And you do have to be able to explain them to somebody else, especially in this situation. So the financials are the gateway to getting this deal done. How the story that they tell is critical. That is your first impression. The first piece of financial information that goes to the buyer, they're going to immediately have this image of your company in their mind. How healthy are they? How good is this company? How much money do they make? So, but I want you to understand that this is the bare minimum. Understanding your own financial position doesn't get you a pat on the back. It is a given. As the owner, you understand your financial position. Now, I'm not going to talk you through how to build your accounting system because, you're an established business. I assume you've been recording your transactions, to some level of consistency while you've been in business. But you might not have looked at it under this lens. So what we're going to do today is we're going to look at this process by working our way. The best way to do this is to work your way backwards. That's where I'm going with this. Figure out what you want your story to be to a potential buyer, what you want your financials to look like, how that needs to be structured, and then work your way backwards to figure out what needs to be done and what is the bare minimum that needs to be done to achieve that result. That way you're not doing too much. You're not spinning your wheels on things that don't matter. You're focused on the absolute critical aspects of this process. And then from there you can plug people in. Then you can say, oh, my bookkeeper can handle this. If they can produce this report for me, then I'll have the time to look at it every single month. Or, oh, okay, I need to hire a part-time CFO and they can handle this process for me. So understanding the process, absolutely critical. Understanding what your financial, your result is going to be should be your starting point, and then you allocate resources accordingly. So preparing for a sale in reverse. So like I said, what story are you trying to sell? Are you trying to tell? What financial metrics do you think tell that story the best? What are the KPIs that you want people to see first? And then, where do you see your business going? Where do you think it's going to be in 5 years? Where do you think it's going to be in 10 years? Because yes, the financial statements that this buyer sees are historical. They're naturally looking at the past. But there are other financial reports that are important, and that is forecasting. And ultimately, that is what the buyer is trying to do. They are trying to guess what's going to happen in the future based on what's happened in the past. So if you have a clear vision of where your company is going, you can better explain how historical performance can lead to that result. And so understanding your audited financials is critical. Understanding what an audit means to you, also very important, because you don't want to hire an auditor and then have them come in and be like, throw their hands up. I can't audit you. You have there's no paper trail. All this. Most auditors aren't going to say that. They're gonna work. They're gonna do the work. If I've been to companies as an auditor myself where they didn't have stuff put together, so you end up digging and digging and digging, and guess what? That means more billings. That means your audit becomes more expensive. And audits are already expensive. Definitely more than $100,000. They are, and that is for the smallest of businesses. So they are not cheap, and the way to make them even more expensive is to just do nothing, and have no structure at all. So you do need to understand what is critical so that your audit to make you more auditable. And so the last point here is, it sounds like a lot of work, but the key here is to educate yourself on the most critical aspects and avoid over-educating. Don't feel like you need to go back to school. You don't need to take these outrageously long online seminars that take like a month or 2 months and have homework and stuff like that. You don't have to become an MBA or a CPA. You just need to know what is critical to focus on and be laser focused on those things. And for the most part, those items are already going to be things that you're likely already hyper focused on as a business owner. Just keeping your business afloat. All right. So, minimal viable financial statements. This is the goal. We don't want to do too much. We don't want to do more than is asked. There are very specific rules for what is needed in financial statements. And there is no rule that says, put other things in there that no one's asked for. Nobody's doing that. You want to do the bare minimum. That's the key. Do the bare minimum, but of the things that are included in there, do them really well. So here's what we're going to talk about. What's an audit? What's the finished product? An audit is a test. And believe it or not, it's an open book test. There are rules. There are accounting rules. They're called generally accepted accounting principles. Yes, that's a real thing. And those are the accounting rules you follow. And those rules tell you thou shalt record an asset when you take ownership, not when you pay the cash. So if you pay someone in advance, that asset's not yours yet, just because you paid for it. But then again, if you bought a car and haven't paid for it yet, or you bought a better example, I guess, would be you bought some inventory and the supplier allows you to pay a month later. As soon as you take possession of that inventory, which could be at any point, various points depending on your agreement with them, you get to record that asset. But it's not when you pay it. So understanding. So those are the simple rules, but in essence, an audit is making sure that you're following all the rules. And the two focuses of an audit are internal controls and financial records. Internal controls means you have processes and procedures in place at your company to ensure your financial statements are complete and accurate. So you're not just putting stuff in your accounting records willy-nilly every month. You actually have a system. I get a bill from a vendor and I put this in QuickBooks, or I have this folder over here, and once I get it input, I put a check mark on it or something like that. Most likely you're giving this to your bookkeeper. So what's your bookkeeper's process? What are they doing? What are you telling them to do? Are you reviewing their work? So the internal control for, say, inputting an invoice would likely be this person inputs it and this person reviews to make sure they put it in there right. And we're going to get into this later on, but a key internal control for a small business, the most important thing is a cash reconciliation. Reconciling your cash to a bank statement every month is the most important thing. It is the first thing an auditor will ask for. Probably. One of the first things they will ask for is that. The first thing they'll ask for is a long conversation about your business. But this is what they're going to look for. They're going to look for a bank statement. They're going to make sure you're reconciling it. They're going to make sure you're looking at items that are reconciling items, think checks that haven't cleared. Is it going to ever clear? Things like that. Then they're going to look at your financial records. This is the bulk of the audit for you. And they are going to do a test of every single balance, for the most part. The small dollar stuff they might not, but they're gonna look at the main things. So let's talk about each of these internal controls. These are all the things you and your employees do to make sure your numbers are right. This includes procedures to make sure fraud doesn't occur as well. So small business focus points for you to think about: bank reconciliations, like I just said, other account reconciliations like accounts receivable and accounts payable, making sure that you have a list of everyone who owes you money and everyone you owe money to, and that it agrees to your accounting records. Periodic inventory counts. Are you literally going out and physically counting your inventory if you're a product business, and making sure that inventory is there and not damaged or lost or stolen? Review of payroll. Are you running payroll on time? Do you have your employees set up right? And this last point is one of the most critical parts of any test of internal controls that an auditor will do, and they will say this to you incessantly until you're banging your head against the wall. Segregation of duties. This means this is essentially the separation of key responsibilities, so there is not one single point of failure. This means you don't give your bookkeeper check writing authority, because if you did, they could write themselves a check and then enter it into the accounting system, and they could, play around with your bank reconciliation at the end of the month, and you would never know, because they're doing all of it. There would be no way for you to catch them misappropriating your assets unless you were to look at a bank statement, but it would be after the fact. You'd have to fire them and sue them to get your money back. So what preventative measures do you have in place to avoid that? Segregation of duties. Number one, making sure that, as the owner, maybe you're the only one who has check signing authority. In essence, this means having someone independent of a preparation process, performing some level of review of someone else's work. And it only needs to be in place for those really critical things, like making sure a customer's information gets input right. Probably a big deal. Making sure pricing terms get into your systems right, that invoices are accurate when they go out, things like that. That you're paying your vendors the right amount, that you're paying the right vendors, that things aren't, you're not making mistakes when money is directly involved. Okay? The next part of the audit, the test of the numbers. And so this is just a big sampling process. And they actually say it. So the deliverable from an audit, I actually had a client ask me this once. What's the deliverable from your audit? The deliverable of the audit is an opinion that says it essentially says your financials are basically correct. They say they are materially accurate, materially complete and accurate, or free of material misstatement, which means, that number material can mean different things. Usually it's based on the type, it's based on the size of your business. So what is the largest number What's the biggest error you could have without your financial statements being materially misleading? And so that is the level of precision that an audit is done with. They do not look at 100% of your transactions. There's no way they would have enough time to do that. So they sample your account balances, and then they test to make sure that the selections they made from that sampling are correct. So for cash is an easy one. You don't really do a ton of sampling, but if you have a lot of reconciling items on your cash reconciliations, they will sample from those. But what they're going to do for cash, they're going to send a letter to your bank. And I'm going to get into each of these, but this one is the biggest one. It gets the most focus because everything runs through cash eventually. And they're going to send a letter, and they're going to make sure, hey, they're going to ask your bank to respond to them directly with the account balance as of a particular date to make sure that money is there. So let's dig into this a little bit more. So an audit, like I said, it's an open book test. For cash, they're going to test your reconciliation. That's what the auditors are going to do. They're going to say, okay, is the bank balance on this reconciliation correct? So they're going to send a letter to your bank, like I said, get that back, and the bank's going to be like, yeah, they have $90,000 in the bank account at 12/31, the end of the year. So the auditor's going to make sure that number's on your bank statement, on your bank reconciliation correctly. And then they're going to test the reconciling items. And so let's just say the reconciling items are some checks you wrote to some vendors. The vendors haven't cleared them yet, so it hasn't been reduced. Your bank balance hasn't been reduced yet, which means that your accounting records balance is going to be a little lower than what your bank statement shows, because you've paid those bills in your accounting records, but the checks haven't cleared the bank yet. So they're going to say, okay, let me see the vendor invoice and a copy of the checks that you wrote to them. So that's what they're going to look for there. They're going to look at subsequent bank statements too, because if those vendors cash the checks, after 12/31, because the audit's going to be done after the fact. So they're going to look at, maybe a January or February statement and see, oh yeah, they cashed it then. So yep, I know that, that was the right amount that they put in there for that check. Accounts receivable. They're going to get a list of all the money that your customers owe you, and they're going to test that on a sample basis. And very similar to your cash balance, they're going to send a letter to your customers asking them how much they owe you. They're going to review customer agreements to make sure the sales price was computed correctly, and that the revenue is being recognized in accordance with the terms of the agreement. And they're going to look for evidence of a customer payment. Similar to what I said about accounts payable, they're going to look for subsequent bank statements to see if the customer paid you. Because if the customer paid you, that's strong evidence that they owed you some money before they paid you. So that's pretty common sense. This is what they do. And then they're going to test an estimate of they're going to test your estimate of what you think your customers are not going to pay you. So this is your bad debt reserve. If you're in a business where occasionally your customers don't pay you, you're going to estimate that on a monthly, quarterly, yearly basis whenever you close your books and produce your financials, and say, of the sales that I've made to date, 1% I think are not going to pay me based on what's happened in the past. And your auditors are going to test that. Inventory. They're going to do an inventory count. Very simple. They're just going to sample your inventory, and they're going to go and count it. They're going to get a list of your inventory from your accounting records, and they're going to say, show me that this exists. Pretty much it. They might look at some supplier invoices also to verify that the cost, the actual amount that you've put in your accounting records matches what you paid for it. They're going to look at the quality of your inventory too to make sure it's not damaged, things like that. And they're going to look at recent sales to make sure that your inventory is not obsolete. Because if it is, you might have to write it off, which means that, you have it recorded as an asset, but it's not worth as much as you have it recorded as. So you have to take it away. not included in your financials essentially. Property and equipment. Same thing as inventory. They're going to make sure that property and equipment is there, that you're not making it up, that you have that van you say you have. They're going to get invoices to verify the cost of the purchases of any property and equipment during the audit period. So usually the audit period is 1 year, and they're going to look at the activity during that year. They're going to look at the useful life. So if you say, I have this car and I think it's going to be good for another 5 years, they're going to make sure that's right, because that useful life determines how much depreciation expense you recognize in a given year. So if you say that you have 3 years left, or if you bought a piece of equipment and you capitalized it and you say, okay, I have this, you put it on your balance sheet and you say, this is worth, this much money, this is what I bought it for, and I think it's going to be good for 10 years, they're going to make sure, is there a history of that? Like, what's your policy? What's your past experience with this kind of thing? Accounts payable. They might send letters to the vendors that owe you to confirm your liability balance. They probably won't do that, but they might. They're also going to review. This is the big one. This is cutoff. Did you record your liabilities in the right period? So they're going to look at your cash transactions after the audit, after the date of the last day of the audit period. So if your audit period ends on, say, 12/31/2025 or whatever, they're going to look at January of the 2026, or maybe all the way through February or March even, depending on when the audit is being done. And they're going to say, okay, they're going to do a sample again of all the cash going out the door, and they're going to say, what's this? And you're going to give them, you're going to be, I paid this vendor, and they're going to say, okay, give me the invoice for that. And they're going to make sure that the services performed by the vendor for that period that you paid them don't relate to a period during the audit period. If they do relate to the audit period, they're going to say, okay, did you record this as an account payable or accrued liability? If no, it's an error. And so that's what they're going to look for. Debt. They will definitely send a letter to your creditor if you have a mortgage or a business line of credit or something like that. They are going to send a letter to your bank and ask them to say, what's the balance? To make sure that you haven't understated how much you owe them. They're also going to look at the debt agreements to make sure they're accounted for properly. Usually with a small business, it's pretty straightforward, but sometimes there are little quirks, little things in there that might have to be accounted for in a different way. They're also going to test your interest accrual. So if you get charged interest on a monthly basis, and you pay the following month, they're gonna test to make sure that you calculated the interest for that period correctly. So if it's a variable rate loan and your interest rate in December is 5% and it goes down to 4% in January, they're gonna make sure that you had interest, an interest payable amount for December computed based on the balance, whatever balance you were supposed to use, probably in November, at 5% interest. So they're gonna test that, trying to make sure your liabilities are accurate. All right. So I hope I didn't, bore your face off at this point, but I want you to understand what goes into an audit so that if you can stand up to that level of rigor, and so, but all that information is going somewhere. What is the purpose? Why do we need financials? Because it's all historical information, so who cares? Because these private equity firms or whoever is going to buy your company, they want to know, is this a good investment? Am I going to make money? Am I going to get a return on my investment? So if they're so focused on the future, why do historical financials matter? Because it provides a baseline for making educated guesses about the future of your company. So they need financial statements that are prepared in a systematic way that follow rules so that they can make a really good guess about the future of your company. And they're going to make that guess based on historical experience from acquiring other companies. They're going to, and that involves comparing to other similar companies in your industry. And so if your financials are not prepared using the same rules as these other companies in your industry, then they're useless because you're not comparing apples to apples. Now, they're going to use this information also to determine the book value of your company. So this is not the fair value of the company, which means the fair value being what would someone buy? What would someone pay to buy your stuff? Your net assets. The book value is simply what you have recorded. And so let me give you an example of how that could differ from fair value. You might have $100,000 in accounts receivable. If you were to sell those accounts receivable, which is called factoring your receivables to another company, they might not be able to collect $100,000 of receivables. They might, if it's a debt collection firm or something like that, they might only expect to collect 60%. So that $100,000 of receivable might only be worth $60,000. And maybe if you kept those receivables yourself, you'd have a better chance of collecting them all, which is why you had it recorded at a higher amount than they would. Or property and equipment. You're going to record at what's called amortized cost, which means how much you paid for it minus the depreciation. So after, let's say you have a building on some land you don't depreciate. But let's say you have a building and you've had that building, and it's a really nice building, well constructed, you've maintained it really well, but the building's 20 years old. You might have depreciated most of the value of the business already, but it might be worth even more than what you paid for it. If you've been maintaining it really well and it's an area that someone really wants to get into and then that building might be worth quite a bit. So the fair value is how much someone would pay for the building, which is likely in this situation going to be a lot higher than what you have it on your books for. But they're going to, these buyers, the private equity firm or whoever's buying your company is going to say okay, what's the book value? That's my starting point, and then you move forward from there. Now, the most important part about this whole process is this company making money? This is what they are trying to find out. Is this company making money? And if they are not making money, is there a good reason for it? Are they just so early stage that they're not quite there yet? So is this company making money? And do I think they're going to make money in the future? Okay? So naturally, this leads to forecasting. You have your historical financial statements as your baseline, and then you move into your forecasting and your forward-looking information. So the forecast serves as the method for determining the future value of the company. So it isn't in and of itself the end value of your company. But a company could be valued based on, at a high level, based on a certain, it could be a certain multiple of your EBITDA, your earnings before interest, taxes, depreciation, amortization. And that's usually done over a period of time. So they're not going to just take a single year. They're going to take multiple years. But that factor they're using is determined based on the performance of similarly acquired companies. This is often called the company guideline method. So they might say, okay, here's your again, this is why your financials need to be comparable to other companies, because in other words, prepared under the same guidelines and rules, because they're going to take your financials and they're going to say, okay, here's this other company that was just like it, similar stage in development and, similar customer base. And, I got this much value, this is how much I would have paid for that company in hindsight. So now I'm looking at, your company, this company would be worth this much money because that one did that well. So that's one way they look at it. Most private equity firms will use a few methods to value a company and compare those values against each other to get to a midpoint. So you have the company guideline method and you have a cash flow method. There are other methods too, but these are the big ones that we're going to talk about. So a discounted cash flow method is the crux, the meat and potatoes of determining a company's value based on its future cash flows. So a discounted cash flow is used to determine the value of a company based on an estimate of how much excess cash it will produce in the next handful of years, usually 5 to 10 years. It tells you the opportunity cost. So it said another way, it tells you the opportunity cost of investing in a company, in your company, instead of some other investment. And so naturally it requires a discount factor, because if you look at the cash flows of your company and you just chart them out over 10 years, you're going to get, let's say, I'm going to do $200,000 of net cash flow in my 5th year, but that's not worth the same as if you got it today. Because if you got it today, you could potentially take that money and invest it in something else where you would earn some level of return or interest. So you have to discount those future cash flows to tell you, okay, what's the current value of all that money I'm potentially going to receive in the future? If I were to take my investment now and invest in something else, would I make more money? And that's what they want to know. And so the discount factor you use is the rate of return an investor would require to invest in your company, given the inherent risk of your business. So if your business and the investment that they want to put in you is high risk, that discount factor is going to be much greater, which is going to result in your future cash flows being discounted more, meaning it's taking into account the fact that you might not get that cash flow in the future because your business is risky. On the flip side, if your business is less risky, the required return won't be as great. So if your financials are not reliable, naturally the results of this analysis won't be reliable. The old adage, garbage in, garbage out. So how do you take this and prepare for a sale? You take a hard look at your financial records. Are they in a state where you could produce comparable financial statements today, comparing the last 3 years? Would you be comfortable signing a letter saying you would test the completeness and accuracy of your financial records? Because an auditor will require you to do that. It's called a management representation letter. Do you understand your financial records? Or do you just pass the work to your bookkeeper and tax accountant? It's okay to delegate. It's not okay to completely delegate the full understanding and analysis of your financial records. You do, as the owner and proprietor, need to understand it and demonstrate that you understand it. Otherwise, nobody's going to trust you. They're not going to want to buy your business. Do you have a clear vision backed by your financial results for the next 5 years of your business? So, do you have a realistic path forward to produce cash flows, hopefully increasingly so? Can that information be supported by your historical results? Do your financials lead someone to believe that you're going to do well in the next 5 to 10 years? If you answered no to any of those things, take a breath. Don't overthink it. Start with where you want to be and then work your way backwards to your intended result. Design a process and financial system that would allow you to produce that result. So put people in the right places eventually, but first figure out where you can best plug and play. Where would a bookkeeper fit into your business process? Maybe you need a part-time CFO, and where would that person fit in? Don't just hire someone and delegate the entire problem to them. Figure out what you want to see. Figure out what it is you don't know, but only the critical things that you need to figure out. What are the critical things that I need to know that I don't currently know? And so once you figure out what that intended result is, compare it to what you're currently doing and start with the big impact items and just fix those. Start small and just try to make progress. It is about progress, not perfection. You do not want to have a perfect process. That means you spent way too much time and money putting it together. So trust me. Now, I want to point this out to you because it truly, progress, not perfection, is such a big deal. And so I'm going to tell you some lessons from an auditor, from me. If someone were to ask me, about this process, this is what I would tell them. Most auditors are much more reasonable than you would think that they are. Some of them can be real jerks, and they're not, but for the most part, they're not trying to say, gotcha. You're hiring them, you're paying them a lot of money. They want to provide value to you, and they can't do certain things because they have to maintain independence to do a audit the right way. But they are going to do everything in their power, or they should, to make your life easy. They want to make this audit as easy on you as possible. So, they are going to be more willing to work with you and guide you to the right answer than you think that than you may initially think that they will be. They can't give you the answer outright, but they can help you think through the process of getting to where you need to be. So if they find a mistake, they're not just going to be like, hey, see ya. They're going to be like, this is what we found. This is what we think is the root of the problem. Like, this is where we think, and they're going to leave it to you to fix it because they can't tell you how to fix it. That would impair their independence. Now, you don't have to do everything right, and you don't have to have a perfect system to pass an audit. Now, passing an audit means you got an unqualified opinion. It means they gave you an opinion and they didn't qualify it by saying it's mostly right, but this wasn't over here. They're going to give you an unqualified opinion. That means you're done. You passed your audit, and you're good to go. You don't need to be perfect. You don't have to be dead right. You just have to be materially right. So whatever that number is, like I said before, that the amount that your financials could be misstated without misleading somebody, that's the number that's the level of precision you want. So you don't have to get everything entered. People fat finger things when they enter them all the time. But if you have a process in place to identify big mistakes, then you're good. That's your job is done. Every company makes mistakes. So again, the key is to have a process that can identify the big mistakes. And this is very important. You need to display a willingness to get it right, not a sweep it under the rug mentality. Auditors their hackles will go up if they get the impression that you don't care and you're just trying to sweep the mistakes under the rug and don't care about the answer, getting to the right answer. They want you to show the willingness to get it right, be ethical, think about this, like you've spent all this time and money and effort, blood, sweat, and tears into building your business. Care about the financials too. Show that you care. Show that you want to do the right thing, and your life will be easier. Now that's the end of the presentation, the slides that I had prepared. And before I go, I want to show you what a complete set of financials looks like. And all right, so what I have here is Microsoft's financial statements. And I wanted to show you what a full set looks like. And so this is way more information than a small business would have to prepare. But what I'm showing here, this is the output from the audit. This is the opinion. This is what you get. You prepare the financials, the auditor comes in, they do some testing, and they say, yep, we've audited all your stuff, for this, as of this date, and for this period, as of for the date of your balance sheet and the whatever period your income statements are. And, we've concluded that your financial statements are materially correct, so right here, we conducted an audit in accordance with this PCAOB. That's for public companies. Yours as a small business would say U.S. GAAP, or generally accepted accounting principles in the United States. And then they have an opinion. Right here, we've audited the consolidated financials and expressed an unqualified opinion on those financials, which means they didn't find anything wrong with them. So now I'm going to show you what financial statements are. What is it? All right, so Microsoft is showing the order sometimes differs, but they're showing their income statement first. So this is the summary, 3 years of income statements, their revenue, blah, 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 blah. I'm not going to go through this, what's included in that. But then you have their balance sheet. So all the stuff, a lot of the stuff we talked about. Statement of cash flow shows, how do you get from your income to net cash flow and all that stuff. These are the core parts, stockholders' equity. These are the core financial statements: balance sheet, income statement, shareholders' equity, cash flow. Then you have what's called the notes to the financial statements. These are where you explain in more detail information about all those account balances on your balance sheet and your income statement. So this tells you, this is telling readers, here's how we prepared our financial statements. And then, I'm going to go through real quick here. I'm not going to go through every single thing. But then they're going to give you some more information on stuff. Microsoft has some investments, so here's what we're invested in. We have some, U.S. government bonds and stuff like that. We got some mortgage-backed securities, municipal bonds and stuff like that. They'll have here's a business combination. They acquired Activision Blizzard, the video game company, so they have some information on that. Here's how much we paid for them. Here's what we got, stuff like that. Here's debt, so like I said, your auditor is going to test your debt. So Microsoft has a bunch of debt that they've issued, so the auditors would test all of this. They would make sure these interest rates are right. They'd look at the debt agreements. They'd send, these are public issuances of debt, but if these were debt that Microsoft got from a bank, the auditors would send a letter to the bank. So this is explaining, how much, what does their debt look like? So investors can look at this and they can say, here's your taxes. How much have you paid in taxes? What's your effective tax rate, and how does that compare to other companies in your industry? And so they use all this information. I'm trying to find some inventory, but it's tough. These big companies, sometimes they're so large. Yeah. So Microsoft's stuff is pretty minimal here because they're so huge that they're only focused on the really big stuff. But, all of this information is used to say, okay, how do I think they're going to do in the future? So an analyst will take this information and they'll say, okay, here's their historical results. There's a lot more in here because they're a public company, so they have to do a lot of other stuff. But investors are going to look at that information, that historical information, and they're going to say, can I invest in this company? Is this worth it to me? Is it a viable investment? I mean, what do I think is going to happen in the future? So they're going to look at the trends, Microsoft's trends or your trends and your financials, and they're going to say, does this make sense? This projection that they have for the next 5 to 10 years, does that make sense? And, so that's pretty much it. So I hope you got a lot out of this. Basically, if I were to simplify this whole thing, it's figure out what you want your result to be and work backwards. Don't do more than you need to do. Definitely hire people and when it makes sense and plug them in to the parts where you can. Don't try to do everything yourself. It's not needed. Don't try to be perfect. Just try to get the job done and, always be laser focused on the story that you want to tell. All right. So I hope this was helpful. If you want more tips and tricks, I have a weekly newsletter. Check it out at ledgerready.work. And again, hit that subscribe button if you want to see more videos like this. And I'll see you next time.